where the future is going. So before I start grilling my panelists, I'm going to hand over to Benjamin to introduce himself a little bit.
Oh, hi everyone. Good morning. Welcome. My name is Benjamin. I'm the founder and CEO of Nala. We do cross-border payments across 9 African countries from the UK, US, and Europe. And we're building payment rails across the continent.
And you've seen their ads on the tube. Good morning, everybody. Thank you for joining us early. My name is Sam Sturm. I'm the co-founder and chief portfolio officer of Founders Factory Africa. We are the most hands-on early-stage investor on the continent. We invest equity alongside our venture studio, which provides hands-on technical and operational support to every venture that we invest in, equity-free. We invest all the way from idea stage up through seed in fintech, ag, healthcare, and logistics. And actually, as of today, we are 5 years old. So we've made 60 investments over the last 5 years. We're in the process of closing our second fund. You might have seen an announcement we recently made about a first close of $114 million with MasterCard Foundation and J&J among the participants. And we're really excited about what that's going to unlock for us and founders over the course of the next 5-10 years.
Good morning, everyone. My name is Kevin Kamemba. I'm a principal investment officer with Women World Banking Asset Management. We're a gender-lens investor focusing in 3 markets, primarily Africa, LATAM, and Asia. We've done 20 investments over the last 12 years, a lot of them focusing on financial inclusion space. Our key goal is to ensure financial inclusion, especially towards the female gender, and happy to be on the panel.
Hi everyone, good morning. My name is Ghartey. I'm the West Africa Investment Manager for Norskin 22, which is a $200 million growth stage vehicle. We invest from Series A through C across fintech, market enablement, health tech, and ed tech, and we're Africa focused. But our priority markets are Nigeria, Kenya, South Africa, and Ghana. We've already made 5 investments. We think from this fund we'll be able to do 20-odd companies over the next few years. Thank you.
Great, thanks guys. So like I said, diverse, broad set of experiences we've got on this panel. So let's kick this off. I'm going to start philosophically, big picture, and then we're going to zoom in on specific questions to do with your organizations. But first, I wanted to direct it to the investors on the panel. What are some of the drivers you see fueling the growth of fintech in Africa, and particularly what's piqued your interest? I'm going to start with you, Bernard.
Great. So when we look at fintech, you'd realize that its success cuts across all sectors of the fiscal economy, whether you're building healthcare solutions, whether it's education, whether it's transport or logistics. That's why fintech is very important for us, just because of how pervasive it is. And when we look at it, we realize how, regardless of what you're building, you need to solve financial inclusion to make it work. A number of things that make fintech exciting for us is just, it's relatively low capital intensity. A lot of the base infrastructure for financial services is already largely solved for across the continent. I mean, if you look at the work that banks have been doing over the last 50 or so years, they've been investing in this space. We can accuse them of being traditional, not efficient, or the good stuff. But they've been building that base layer. Same with telecom companies. They've been investing on the continent over the last 20 to 30 years. So that base infrastructure for financial services exists and is largely solved for. And once you have that, it's easy to innovate on top of an existing infrastructure to make it less fragmented, to make it more efficient, and to expand it into all customer segments across the divide.
Great, thanks, Bernard. Before I go to you, Sam, wanted to get the perspective of an actual operator.
Someone who's built those rails that we're talking
hopefully
about.
Hopefully a contrarian perspective.
I respectfully 100% disagree. I always say, I think payments in Africa are 1% built. And you have to also think about it, put yourself in the bank's shoes, right? Some of the banks have historical legacy technology they've been using for 15 to 20 years. Now, within those banks, a lot of them don't have tech teams or software engineers that are fully dedicated to optimizing for safety, but also efficiency of their goods and services that they provide. Not just with banks, but also with telecoms. We work with 30 telecoms across Africa, 300 banks across Africa. So we see when API calls go down. I'll give you a simple example. We do international money transfer from the UK, let's say, to Ghana. And let's say we're dispersing the payment. We collect the money here. Somebody's sending $1,000. In your MTN Ghana wallet, you can only hold like $3,000, right? Let's say his balance is $2,800. I'm trying to send $1,000 to his account. When I push the transaction, I just get an error, failed. There's no reason why it failed. There's no, oh, this person's wallet is full. There's a lack of float shortage or whatever. And there's so much more that can be operationalized through technology. All this manual human error work, which is exorbitant, and we see 11 key errors, especially across international money transfer, that haven't been resolved for directly. And I think there's a huge opportunity to build there. And I think payment rails across the continent are like right at the nascent beginning stage of it. I think there's going to be 6 to 10 more companies building infrastructure rails across the continent that will do well over the next 10 years. And I've seen this across many different regions. So respectfully, I would disagree with that, because we work with all the APIs that exist today, and it's tough. It's really hard. There's one of the, we're actually coming soon, we're launching our own API, because what ends up happening, I call it like the water bottle, right? You're trying to build a consumer business in Africa and scale it across the continent. But what happens is treasury is really tough because FX is a massive problem, and then infrastructure is really rough. So what ends up happening is you end up building treasury infrastructure and then payout infrastructure for which is rails, right? You apply for local licenses to be able to do FX better. Now you own the bottom of the stack, which is like a payment service provider license. We have 5 payment service provider licenses across Africa. Now what ends up happening is large companies come to you and who are consumer facing, like, hey, can I use your rails that you've built, because you also got really good FX to pay out into these markets? So recently we signed a very large remittance company that's based here in the UK that is going to be using us for payouts. Not because we intended of being a payouts business, but infrastructure is foundationally really tough on the continent, and payout reliability is really rough, that we end up being an infrastructure company, not by choice, but by nature of the market.
I'm going to come back to that actually, about infrastructure and also regulation and whether it enables or constrains fintech business. And I hope you all have diverse sets of opinions, because this makes it super interesting. But before I move on, Sam, do you have anything to add on your views?
So I think there's 2 things. I think that Benjamin's point about the licensing and sort of the value that adds, we've seen extensively in our portfolio. And I think it is, I think to your point, a challenge and a little bit unfortunate. Generally speaking, you wouldn't expect a startup, forget Nala's size, a pre-seed startup that's trying to build payments, having to build licensing, having to get licensing and having to build infrastructure. So the fact that infrastructure still has to be built, which it does, even in, and I will say, we are headquartered in Johannesburg and have the good fortune, this is being recorded, the good fortune of working closely with Standard Bank. And it's the largest bank on the continent, and in theory ought to be the most well networked across the continent. And we've seen market to market, new licensing, new infrastructure every time a venture tries to move markets. So I think that's a huge hindrance, and I agree. There's still a lot of opportunity there. I think the other thing we think about a lot is sort of like some of the sector-specific fintech, some embedded finance in sector-specific value chains, and because we sit across value chains, we're really interested in what I would call fintech for healthcare, fintech for ag. Fintech for logistics. So when you look at the financing needs in some of these value chains, places where there's a lot of friction, whether it's asset-backed lending, whether it's some of the invoice factoring, and each of these, what we've seen is you might assume that there's an invoice factoring solution that could work across sectors, but the use cases are so different sector to sector that we really believe that you have sort of fintech solution. There's room on the continent for scaled fintech solutions in specific value chains, and you're starting to see some of those get really big already, and we're really excited for the reasons Bernard talked about. They are low capex, but really fuel these value chains, and we're excited about that.
So just a follow-on question about embedded finance. Obviously, at FFA, you've spotted that this is a sweet spot, and we're seeing more investors kind of investing along this embedded finance. Do you think this trend is going to continue? And what do you think the implications are for existing investors that are not playing in this space?
That's a good question. So yes, I think we will continue to see it. I will tell you one of the real challenges embedded finance requires, it is infrastructure-like, but it's capital intensive, right? And early stage, equity capital and risk capital is an expensive way to on-lend. And so I think that the opportunity is for, we've talked to a number of people here this week, the opportunity is for some more innovative financing solutions of these types of opportunities early on. Because what we've seen as one of the biggest constraints is that ability for embedded financing solutions to produce the track record where, again, a standard bank or a Stanbic, Sterling Bank, whatever it might be, is willing to lend through them. Some of the larger TLGs, the IFCs, even that's the holy grail. But the initial track record and the initial traction and getting that going is, I think, there's a lot of friction around that can still be solved, I think, through some business model and sort of like financial innovation.
Right.
Thanks. So I want to move the conversation a little bit to discuss this tension between profitability and returns. And I'm going to move over to Kevin. What strategies and business models have shown promise in tailoring fintech products to the unbanked whilst maintaining profitability?
I think maybe from a top-down perspective and how our view of fintech is when you look at countries, and especially for the developing countries, so looking at Africa, looking at Asia, one of the big challenges you have is how the geographical structure of these countries is, right? So you have populations that are more dispersed, more focused in the rural areas, and it's quite expensive for a lot of the traditional banking models to be able to traverse this kind of infrastructure. So the challenge always becomes that your ability to reach this customer, the cost is too high that you're not able to operate profitably. And I think this has been one of the key drivers towards more of the tech model. I think the biggest revolution in terms of financial inclusion came with the onset of the mobile telephone, right? Now you have increasing financial inclusion across these markets. However, if you look at the level compared to more developed markets, you still have a very huge gap. And contrary to what a lot of people will think currently, there are actually not as many profitable fintech models today. A lot of them are still experimenting, and there's still a lot to be done. One of the challenges you have would be around ability of the traditional banks to work together with the fintechs, right? And more probably that's going to converge. You have fintechs that are a lot more agile. I think he was explaining about Nala and what they're doing. And one of the things you see, anytime they find a hurdle, it's very easy for them to innovate compared to your traditional banking models where the regulation and the structure of how the business is formed takes too long for you to be able to innovate. However, coming down to the fintech side, one of the biggest challenges is around your mobile penetration. That's one of the key concerns you have. You have issues to do with low incomes. You have the literacy levels. So in terms of people being able to, one, own the smartphones, operate the smartphones, they remain a key challenge. And one of the other biggest challenges remains financial literacy. So looking at markets, especially sub-Saharan Africa, you'll tend to have a lot higher NPLs where you don't have the contact, right? It's also partly driven by that lack of face-to-face interaction. And a lot of the fintechs have to find more innovative ways to reach these clients and to have a bit more of a social touch towards the innovations. Some of the failures that come in, for example, would be banks creating mobile applications, and then you do them in English, and yet a big chunk of your population speaks in local dialect. Yeah. And those are some of the infrastructural challenges that will remain. But from a fintech perspective, especially where you have a low-touch model, and this I'm talking more towards providing credit services, your biggest cost becomes your credit default. And that, unfortunately, remains one of the key reasons why the cost of credit still remains extremely high. A lot of the banking services that need to be provided still have to be provided in conjunction with traditional banks and MFIs, which unfortunately take very long to be able to implement and don't move at the same speed as the fintechs. However, over time, with scalability, I do believe we'll see a lot more profitable models. I know at some point we'll probably discuss the issue about saturation, but looking at the private credit as a percentage of GDP, a lot of the developing markets, I think, are significantly low. Sub-Saharan Africa, you're talking about below 40%, compared to developed markets, where you're talking about more than 100%.
I'm going to kick the question to Bernard in a minute, but I wanted to touch on something you said around customization of products to the target market, and not because I'm a woman, but we need to talk about the gender angle to things. So kind of from your perspective, how are you approaching customizing products and policies to have a gender approach, processes and systems to align and bridge this gender gap we're seeing on the continent? And what do you think other investors should be doing? And that's for you, Kevin, and then I'll go back to Bernard.
All right. Thanks. So I think one of the so when we look at, as I said, I think mobile telephony had the biggest revolution towards financial inclusion, especially for Asia and Africa. However, if you look at the data, there's still a huge challenge, right, in terms of the gender gap. Talking about mobile ownership, you have about 7% gender gap. If you talk about owning smartphones, you're talking about 17%. Access to internet, 19% gender gap. But again, this is at the global level. When you come down to the level of Africa and Asia, you're talking about almost 30 to 40% gender gap. And unfortunately, everything now runs through the mobile. So if you go down to your day-to-day, in the simplest form, right? I'll use my mobile phone weather application to check whether it's going to be raining in London so that I can park an umbrella or not. While my mother in the rural areas, this app would actually make a much bigger difference for her if she could tell whether it's time to plant or not. Right? Simple things like government being able to send text messages to farmers, whether it's about improving methods of farming and all this. If you already have such a big gender gap in terms of probability of ownership of mobile phone or access to internet, then the female gender is already disadvantaged, which is a bit, I find, to be unfortunate, given that about 50% of the women, both in Asia and Africa, are actually employed or are directly involved in the agricultural value chain. About 60% of micro SMEs tend to be women. So I think the first solution for you to be able to solve for this is to be able to provide credit access for them to be able to own a mobile phone, to be able to provide financial literacy training, to be able to actually reach these women, and then to also blend the culture of these places. In Africa, as an example, if you just come up with a mobile application and you ignore the fact that in some cases you might need an agent to actually help these women to access this application, then you miss out on this. Beyond that, you have issues to do with biases that are inbuilt into algorithms when you're doing either your credit scoring or your ability to reach these women. And these are some of the things that at an organizational level, we work together with our NGO side to try and come up with ways to generate products that actually make sense, that reduce gender balance. But one of the big challenges, for example, is that if you found a financial institution that provides mobile loans, to a lot of impact investors, they consider this to be an unproductive asset, right? It's considered a consumer loan. In our perspective, I think it's very important for us to be able to empower the woman to own a smartphone to be able to access internet, because this is where a lot of the financial inclusion channels are going through.
Great, thank you. And I'm going to go.
Can I have a
Please.
Because I think, I mean, we are unfortunately not representative, but I think like part of it is, the way we think about it is like, this is not to let ourselves off the hook at all, because it is, it is important. But I think part of it is like we need to be investing in more female founders, and to do that, you need more female investors. I think that's just part of, like, you talk about gaps. I mean, I think my fear is we make access to tools a panacea, and the concern there for me is it's easy to fall into the global trope of Africa rising. You look at, I mean, how long have we been talking about young population and increased mobile access, and which is true, and yet it is like that's not going to be a global a young population is an opportunity, but it's certainly not going to be the solution. And in many ways, it provides us with enormous challenges still. And so I think that yes, access to anything we can do to get more of the tools in people's hands, but that doesn't let us off the hook, founders off the hook for designing for their customers and understanding who their customers are. And as you said, productive business owners and those driving particularly informal economies are female, and finding female founders who understand that and naturally think about women as their users is important, and having female investors who are investing in female founders is incredibly important as well. And so I think that's a big part of it. And that's, as non-female investors and founders, also part of our responsibility to make sure that we are thinking about that and incorporating that into the way we work.
I agree. It's the triage, isn't it? You can take it a step further and say you should have female allocators, because female allocators will back female investors who will back female founders. So it goes all the way up the value chain. So yeah, completely agree with that. But I'm going to go back to you, Bernard, because I wanted to get your views on, can you actually make profit by focusing on impact fintech?
Yeah, that's a good question. So for us, even though we invest at growth, a number of the companies we look at will still not be profitable on a bottom line basis. However, profitable unit economics is something we focus on from day one. So you can serve your customers profitably. Unit economics can be profitable. You may not be profitable on bottom line, but once you have profitable unit economics, I think you've reached some form of product market fit. I also want to highlight that as ecosystem players, we shouldn't look at serving unbanked customers and profitability as two mutually exclusive elements. In actual fact, both are meant to coexist, and in certain business models, they have. What happens is, and not to accuse founders, but we sometimes take solutions that have worked for other customer segments and try to reach unbanked customers with the same profile of products, but that doesn't work. I mean, go-to-market is very important in reaching, in extending financial inclusion. So you need to have products that are tailored to meet the specific needs of unbanked customers. I'll give an example. So we invested in Time Bank in South Africa. Even though it's a digital bank, they quickly realized that there's a massive gap in financial inclusion. So what they did was to partner with one of the largest retail outlets in the country to position these physical touch points, which are like small kiosks where you can onboard in a few minutes. And they're taking the products to the unbanked customers. These are places where they shop on a daily basis, and they can go to the physical kiosk and onboard in a few minutes. Now, this does a number of things. One, it creates an opportunity for the customers to interact with a system or somebody, and this builds trust and helps to deepen customer loyalty. So what I'm trying to say is the two are meant to coexist, but we just need to make sure that we have the right product tailored to meet the specific needs of unbanked customers, and that is how we can unlock profitability in this space.
Thanks, Bernard. Now I want to go back to the entrepreneur perspective. So Benjamin, we all recognize the fact that there are new fintech startups starting every single day, addressing a whole plethora of issues. But from your perspective, do you think the market's saturated? And I guess your answer is no, based on what you said earlier. But how do you think, where do you think there are untapped opportunities? And I think you started talking about that in the infrastructure space. And how should a fintech entrepreneur differentiate itself in the market at the moment? So that's 3 questions in one, actually.
Do I think it's saturated? Absolutely not. I think there is, as I said earlier, I think payments in Africa 1% built. I don't know if my mic is on. It is. You guys hear me? No? Okay, cool. Yeah, so I think payments across Africa is 1% built, because I think every single time we're building something, even at Nala, I'm like, wow, I wish somebody else was doing this so I don't have to build this. Yeah. I wish somebody else was doing this so I don't have to build this. And consistently, that's the question. And you can build anything, but you can't build everything, right? You have a limited budget, you have a limited runway, you have build towards profitability. All the points that they've been talking about are absolutely things in the decision-making process that we have to collectively think about. So I think there's a lot of space to build many more tools and many more things. So you asked for examples. So when we were getting into cross-border payments, people call us a remittance company. I don't like calling us a remittance company because I think we're building payment rails and we're a payments company. But our remittance products are a flagship product that most people know us for with Nala. But let's just take the remittance category just to explain it here. Remittances in Africa in 2015 was $48 billion. In 2020, $98 billion. How did it double in 5 years when there wasn't a mass movement of people abroad? It just, there's a couple of things you have to keep in mind there. A lot of these transactions weren't happening digitally and still don't happen digitally, and now are finally getting accounted for digitally by banks and telecoms. So you can see like, oh, you know, it's a $100 billion market in 2020. I think realistically, it's about a $300 billion market just to Africa alone from, you know, foreign markets. I think a lot of that stuff isn't calculated at all. If we go to East London, we're in London today, if I take you to East London to my barber, like in Romford or Dagenham, and we go get a haircut, I'll take Will, we'll go get a haircut and be like, hey, look, you ask the barber, like my barber's Ghanaian, I'm like, hey, I want to send money to Ghana. My barber will pull up their cell phone, okay, and show you on WhatsApp 4 or 5 different rates and ask you, what rate do you want? And I've tried this, I'll take you, I'm not joking. And you, like, okay, you pick the rate, you agree on the rate, you give them the phone number to send it to. The money will arrive in Ghana in 3 hours, right from here in London, right? And so there's this whole manual Hawala network that still is the dominant player in cross-border payments. So we think, oh yeah, digital services are already done, there's all these remittance companies competing. I was asked the same question when we were starting in cross-border payments. Some of my investors were like, yo, you'll never make any movement in this space. I'm like, cool, I've never lived in England before, or getting customers in England, and my investors are like, nah, there's no chance you can do this. Those are the same investors emailing me a year later saying, can we lead the next round? So my point is, if you focus on falling in love with the problem and understanding the issues the customers are directly facing, there's a lot of patterns. So just within remittances, okay, there's payments, that's one tiny piece of it. Other businesses you can build just within remittances. We see in the UK every day, every 25th of the month, we see our highest volume that's transacted. Why? Payday. In the US, 16th and 26th, payday, same thing. So it gets to a point where our retention after 12 months is 74% for our customer, transacting customer. So therefore, you can match the pattern where if a user is using the product every single month, you can start looking at, do you offer send now, pay later options with lending? Because they know they're gonna send money to their mom or something like that on that 26th day. Can you offer a line of credit for them in case they have a health emergency or something like that? That's one opportunity. Another opportunity, let's say in Nigeria, where card prevalence is very large. Can you issue a card for the recipient where you can control what your mom or your father or your uncle that you're sending a card to is spending on, and you can monitor the transactions from the send market in the first place? Because a lot of people want to send money, but they want to know that the money's being used for what they're sending it to be used for versus somebody saying, I need it for school fees or buying a laptop. You know, the third thing you can do within there is health insurance. The majority of transactions for remittances is about healthcare, right? I joke around with my friends who build insurance companies. I was like, building an insurance company in Africa is very hard because your competition is literally Jesus. But realistically, people whose relatives live abroad here have been exposed to health insurance. Like in the UK, you have the NHS. In the US, you have to buy health insurance or else like you're in big trouble. So they have that exposure naturally, and that's an opportunity where can you, instead of paying for a payment, tell them these are the top hospitals in the country, we'll do. So just within the remittance category, there's multiple businesses that you can build that can be category A leaders. We as Nala will never be able to build all of those things. Those are so many business lines that we can never explore directly, right? And so I think across the continent, there's massive elements of items that could be built. And one of the big ones, the last one I'll touch on, I know I've talked for a while, is FX. See, look, I said this yesterday on the panel I was speaking on, and I think we have a responsibility to think about this even as investors. I'm not an investor like these guys, but I operate in the market. Africa's got the largest dollar shortage in the world. That's not going to change anytime soon. The dollar is the world's trading currency. Yeah, South Africa is trying with BRICS and all this other stuff. Whether you like it or not, the dollar is still going to be prevalent for a very long time across the continent. Now, what ends up happening is because there's a trade deficit, Africa is a net import region. We import more than we export. The only countries that export more is Cote d'Ivoire across the whole continent. Now, because of that, we are consistently in the need of buying dollars collectively. And so all these banks are chasing for companies who are bringing in dollars. So when we bring in dollars, let's say to Tanzania, to Kenya, to Uganda, to Ghana, banks come up to us like, oh, I'm willing to pay a premium above the mid-market rate for these dollars because they know they're going to sell it to that importer who's importing goods and services at a premium as well. So that's why you see a huge fluctuation in FX rates that these services and remittance products can offer and at scale. I think that's a huge opportunity to be solved because there's inbound and outbound traders that you can do a lot of things. The challenge is it's a regulatory nightmare as well because regulation have full incentive to protect the currency because you don't want a devaluation and what happens. The case study A, example A is Zimbabwe, right? And so I can understand and respect why regulators are super like tight on that, but I think that's a big opportunity that I've not seen solved at scale across the continent.
A few things that Benjamin said that I think are interesting.
I have a separate question for you actually following up on
Yeah,
this,
of
but I'm
course.
going to come back to you because we've talked about the opportunity. Love what you said about the high retention, product customization, but I want to talk about the challenges. But for Sam, I was actually going to come to you next. As an investor in fintech startups that operate across many different countries, and you mentioned in your opening how it's not just capital, you have a hands-on approach to portfolio management. You can respond to what he said, but also can you add, what do you guys do? How do you manage supporting fintech startups at different stages of their evolution across different countries, navigating regulatory challenges? What's your approach to it?
It's a good question. I think the first thing is, I think, something Benjamin said, and I will get to your question, I promise, which is sort of the burden of, I mean, as you said, you guys are building a payments company, but what you just described is a treasury company, right? Like, is not something that a startup ought to have to build as well in order to execute. So I think that friction is a challenge. In terms of how we think about those challenges, I mean, it's part of the reason. So we are based in Johannesburg. We have an office in Lagos. We have an office in Nairobi. We have legal teams. You might know members of our legal team. Abby's brother is our head of legal. So, but I think that it's a nightmare. Like we have no silver bullet. It really is a nightmare, and the friction is real. I do think, look, the licensing piece that Benjamin spoke about, which again isn't something you'd expect for an early stage venture, the ability to get licenses early on is really important and really valuable. And so one of the things that we've been working on is finding ways through our partnerships and our sort of local entities to help early stage ventures get some of the licenses much sooner than they otherwise would. And I think that's part of it.
Can I add a quick caveat on
please.
that one? I think even with licenses, right? There's one license we just received on Friday. We applied for a license 2.5 years ago.
That sounds right.
That's death in a startup, any startup. Like, you don't have 2.5 years. Like, you have 6 months, you have 10 months, you know? So it's frustrating, especially because like you're hoping it's like vibes and inshallah, maybe on Friday that license is gonna come through, and you've been praying that for like 120 weeks in a row. And we got one on Friday. Even when we received it, I wasn't even happy. I was just like, cool, like, because we have so many outstanding ones, and he's right, because I think it is, and even with a lot of compliance rules, a lot of African markets don't even discuss with each other. So the rule in Rwanda versus the rule in Ghana versus the rule in Nigeria versus the rule in South Africa is all different. Like, oh, we want 4 compliance people for you to hire in SA even before you've gone live. Which startup can afford to hire 4 compliance people in Cape Town or Johannesburg even before you've even gone live in that market properly? It's tough.
No, I think it is. Again, I wish that I had a better answer of like we've solved this. Look, we've done 60 investments in I think 8 different markets, and it's a challenge. We have a venture in our portfolio that speaking of what Benjamin said, that focuses on healthcare. Let's call it healthcare remittances, specific healthcare remittances from the U.S. Back to the continent. It's called Flurry, solving the exact problem, and you know, Sam, the exact problem that Benjamin's speaking to. I think that is part of the solution. I think the other thing is and one of the things that we've seen is really valuable, and again, you spoke to this a little bit, the closer that a solution can get to the point of sort of origination of capital. So whether that is in remittances, or if you're another consumer angle is as close as you can get to the paycheck, right? That point where capital is being originated at a consumer point, we've seen a lot of value in ventures that are thinking in that way. But again, the licensing, PSP licenses early on are valuable, but super expensive. And I mean, I don't know, you guys at scale, it's obviously different, but you know, for us, it remains a real challenge.
So I'm going to switch gears a little bit, bring you into the conversation, Kevin, thinking more around financial resilience. So you guys participated in a funding round for Lula Lend and also for Purchaser earlier this year. So from your perspective, given that these startups are providing credit facilities, like you mentioned earlier, working capital to SMEs, what role do you think credit plays in just ensuring financial resilience as a whole on the continent? And I think you touched on it earlier in your answers, but...
Yeah, I think one of them is going to be ability of the fintechs to work together with financial institutions. And I think that probably goes back to the issue around licensing. And sometimes, so an example would be in Kenya, the central bank came up with a new digital credit providers license. And one of the challenges we find even with the central banks that they don't have a dedicated team that understands digital credit providers. So even they take very long to be able to get the licensing done. Since the regulation came in place, I think they've received more than 900 applications. So far, only 32 have been approved 1 year down the line. And even for the ones that have gotten the approval, when you go back to them to get an approval on a product, it will take you, as he explained, almost 1 year, right? And in that time, you already have contracts that are already signed with clients, and you're not able to begin providing that credit service. So I think one of the big ones is going to be around regulation and how supportive that regulatory infrastructure is towards the fintechs. I think it's probably about time that the regulators figure out how to strengthen their teams with people who have a better understanding of fintechs and how agile decision-making is towards them finding that solution. Understandably, for the regulators, there's a risk of protecting the mass population, but it always also makes sense to do test pilots, which allow them to get a better understanding in a quicker way. Okay, so that's one of them. I think the other one is when I talk about partnering with the financial institutions. Lulaland, one of the things that they've been working on now is piloting the banking component of their business. But part of the reason why they're doing this is not so much because they want to move into the banking side, but more to find ways to have better visibility on how your clients are transacting, because this helps you to improve on your credit scoring models. But the largest one for us, I think, has been in terms of the embedded finance. And I think that's one of the models that you're finding to be very interesting. More because you have all these thin file MSMEs and SMEs who are now able to have some kind of P&L where you're able to view the kind of transactions that they're able to do, which allows you to, one, do credit scoring, but over time to get a lot more valuable information to improve your credit scoring models.
So I want us to talk a little bit about how you spot the winners. So I want to move to you, Bernard. You guys invest in growth stage, fintech companies. So what's important from you from an evaluation perspective? What do you look out for when making the investment decision?
Yeah, so I was, I was mentioning this earlier. So we invest across 4 main verticals: fintech, market enablement, health tech, and ed tech. And we have the same criteria regardless of what business model we're looking at. And in each of them, like I mentioned, profitable unit economics is very important. You may not be profitable on a bottom line basis, but the way your go-to-market should be profitable, at least. We also look at models that have relatively low capital intensity, like I mentioned, and we want to see fast growth, high margin businesses. And we also want to see, I mentioned fast growth and high margins. I think when we see a number of these elements, balanced in a business model, it gives us comfort that, this is a business that has reached a true product market fit. Especially in the spaces we play, you want to make sure the company has identified, it may not be all, but has found a fine balance across a number of the things that are important to us. And finally, of course, you want to make sure that you have a founder you can work with, right? Because our business is a trust business. We just don't want to give you capital and fold our hands and walk away. We want to find founders who are very collaborative. We may not know the business as much as they would, but just because of the breadth of companies we speak to, there are some insights, I'm not sure Ben thinks, but there are some insights that we can also bring to the table. So finding founders that are collaborative and open to, dialogue and support is also very important. And that's a critical component of how we evaluate businesses.
And Sam, are there any nuances for you, given that you operate at the earlier stage of the spectrum?
Much earlier, yeah. So we have much less, obviously, data to make decisions on than the Norscan team. I think there's a few things, earliest stages, and Benjamin spoke to this, is a deep obsession with not the solution but solving the problem, right? And I think that founders who are obsessed with a problem rather than their solution to it are much better than founders who are obsessed with their solution and think they've figured it out, because we were wrong. Much as everybody, as early as we were going, ourselves as investors, founders, like we are wrong more often than we're right. And so if a founder's obsessed with solving the problem, they'll figure out how to solve it rather than trying to push their solution. I think the things that we see fail the quickest are founders who fall in love with their solution despite what the market might tell them. I think the other nuance is, how you think about traction for us. And so again, what we look for early on are sort of promising, often promising signals. And those might not look like traditional growth or user numbers, but you might see things like a really strong activation rate, even on a small customer base, a really strong activation rate. Or you talked about sort of recurrence of use, right? And at the scale you guys are, that's meaningful. But early on, when you're looking at a pre-seed business, it might the sort of magnitude, the quantum might not be interesting. To give you an example, one of the businesses that I'm most excited about in our portfolio, aside from off-grid energy, the off-grid finance, the founder of whom just walked in the door. One of the ventures that I'm the most excited about, one of the earliest signals we saw was they ran one of their earliest experiments, they ran a cold email campaign to merchants, and the click-through rate on their cold email campaign was like 25% or something like that. That's unheard of on a cold email campaign. And it was to 500 merchants, something like that. And this was pre-product. This was when they were still sort of testing value propositions. But what that told us is, a cold email that had their core value prop in the subject line that led to a click-through for people to sign up at 25%. Well, that gives you confidence that there's a there, and that there's a user base that's excited about what they're building.
And then just to get your perspective, Kevin, how do you spot a winning potential investment, or do you focus a lot on the impact of the investment on the SDG side of things?
I think it's probably a bit of a mix of the answers that you got. For us, it's also the concept and what is the problem that they're looking to solve. And for us, also having in our previous fund the traditional investments, the MFI and banking, we try to map the two and look at technology more as an enabler, right? So one of the key challenges for us, of course, is around valuation. One of the big challenges of investors is that balance between how you do valuation as a private equity investor versus how you look at it from a VC angle. But the biggest thing for us is, one is the entrepreneur that you're working with. I think that need to be collaborative, but as well as the idea and how we see that working in the grand context and how technology will enable that context. They will definitely not all be winners, but we'll see.
And I want to close by getting some of your views, Benjamin. So you've talked a lot about the opportunities in this space. But what are some of the challenges? If you cast your mind back to a few years ago when you were starting, hopeful, not jaded, so what were some of the challenges?
Revisiting your PTSD
moment. Yeah, exactly, because we just love to do that on stage. Yeah. What are some of the challenges that you had to contend with then? And now, at a later stage, what are some of the challenges that you're facing?
And if I can ask you to do it in under a minute, because we're out of time. Thank you.
Cool. All right, so 18 months ago, we were 7 people. Today, we're 100. Okay, so in the last 18 months, everything broke at the company. Everything broke at the company. Like, treasury is a core part of the business. I used to do treasury myself. Now it's with my COO. Now it's like, oh, we need to hire a better head of treasury, right? And all these functions that grow and evolve and become something big, the cost of mistakes become very expensive. If somebody puts the wrong pricing and you're moving millions of dollars that day just to that one country, that can cost you like 80 to 100K on P&L, right? Just in that single day. So, those, like finding the right team, I think is the most important thing. And if I were to do it differently, it's tough because at startups you start with generalists and you scale with specialists. And at the beginning you can't afford specialists, right? So you have to most of our early hires are like some kid from university, some intern, like fresh, like no work experience, like he'll work at Nala. And some of those people are leaders in our organization today, which is fantastic. But a lot of people can't grow as the organization grows. So when that function gets too big. So I think with challenges, people challenges will never stop. They'll just keep growing as the company grows. Regulation challenges will always happen across every market you operate in Africa. VC challenges, all these guys. Big ones who don't believe in you. We have like over 300 rejections. Actually, I think I applied to Founders Factory like 4 or 5 years ago. I never even heard back from them. So maybe they could have made a lot of money on paper if they invested in Nala. But no, this is a serious challenge because like we have people who don't believe in you, and that's fine. But if you're going to be a founder, I tell my team this. I said, look, if you don't take responsibility, you take orders, and that's a principle of life. So as you're building your business, right, like these negative experiences will consistently happen. Controlling your mind is the most powerful thing you can do as a founder.
Great. And on that note, thank you so much, my panelists. This was such a good discussion. Thank you.
Thank you so much.